Just had our first bank failure in months just yesterday. So we had Citizens Bank close down two of its Iowa branches. And this is the first bank failure we've had since July. It's the fifth of this year. And this is coming at a time where losses on bank portfolios are at all time highs. And we can see that here in this chart. So this shows me the losses that are on a bank's balance sheet in aggregate, and they are at all-time highs. So this is very concerning. I'm quite worried about this, but let's talk about it. Let's talk about where we think this could be potentially going, what other banks are at risk, and then at the end of the video, I will show you a major signal of weakness within the banking industry. So with that being said, let's talk about it. So yes, we're not at 2008 levels, right? In 2008, as you can see in this chart here, we had 25 bank failures. Right now, we've only had 5, including what just happened yesterday. In 2020, in 2022, we only had, we had 0. In 2021, we also had 0. Even in 2020, during the COVID pandemic, we only had 4 bank failures. So this isn't very typical, right? It's not normal to see over 5 bank failures, or 5 exactly in our case, in a year. That doesn't typically happen. That signals weakness within the banking sector. And I really think when you kind of peel back the onion on the banking industry, there are massive issues. And it really comes back to the losses banks are holding on their balance sheet. So how does a bank get like this? How does this happen? What does it truly mean? I'll explain it very simply, so you can kind of understand even with zero prior knowledge. So first off, you have to understand this, that when interest rates go up, bond prices go down. Banks invest in bonds. So when they invest in bonds and then rates go up, that makes their bond portfolio come down in value. So that's kind of just a first general relationship you need to understand. And since 2020, interest rates have gone up 1,100%, which is absolutely crazy. It's an insane gain over just a couple year period. Talking about 3 years, an 1,100% gain in interest rates. That brings down massively the value of bonds that were bought in 2020. That happened with SVB. That's why that bank went under, is because they got an influx in cash during 2020, and they put it all on the long end of the treasury, and they bought a bunch of bonds, and that value had came down for those bonds, which led them to fail. And this is somewhat consistent throughout the banking industry. We saw a lot of bond buying in 2020, as there was a bunch of cash coming into the system, and banks were basically just buying bonds with that. Unfortunately, bond values have dropped drastically in reaction to rates rising. And if you may have lost me in that last little explanation, this is for you right here. So let's just give a simple example. So let's say we open a bank, Happy Investing Bank. We opened up in 2020, actually, believe it or not. We only have 2 customers. Just keeping it simple for numbers' sake. We only have 2 customers. So Jane and Joe here gave Happy Investing Bank $50 each in 2020. So we have $100 in assets. That's all we have for the bank. Well, what does a bank typically do? When they get assets from customers, they go out and they actually invest that money, right? They buy bonds more than not. So as Happy Investing Bank, we are going out, we are buying some bonds with that cash. So what do we do? We buy bonds, as I said, and in 2020, once we got that $100, threw it right in bonds, baby. Put it in bonds. Value of my bond portfolio in 2020 is $100. In 2021, interest rates go up. The value of my bonds actually went down by $10. So now I'm holding $10 in losses on my bond. In 2022, interest rates continue to go up. Unfortunately, my bond portfolio now is only worth $70, and I have $30 in losses. In 2023, rates continue to go up. My bond portfolio is only worth $40 right now, and the hold to maturity losses are 60. So I will get back my original investment as long as I'm able to hold through the maturity period of those bonds. The issue is, let's say Joe and Jane, tough times in the economy, they need their money now. Let's say Jane says, you know what, I really need $30 today. Let's say in 2023, let's say, it's this year, and Jane says, I need $30 right now. And then Joe says, I need $20 today. Well, if you look at the value of my bond portfolio, it's only $40. So I'm $10 short. I can't give Joe and Jane the money that they want because unfortunately I lost their money in the bond market. That's basically what's happening to these banks that fail, is that yes, they aren't necessarily insolvent, but once all the depositors come and ask for their money, they're not able to pay. So that's kind of why banks are going under this year. It's exactly what happened to SVB. They took in a bunch of money, made a bunch of investments at a poor time in the bond market. Then some people came and asked for their money. They didn't have money to give out because they lost basically what they were collateralizing those deposits with. So that's how a bank goes under. That's how hold to maturity losses really negatively affect a bank. And it's bank runs typically work like this, right? So it's only a huge deal if people come and they ask for their money. Well, when economic times are tough, people are losing their jobs. We just saw a pretty weak jobs report. People are more likely to come and ask for their money, right? If people, kind of are getting somewhat scared about bank runs, a lot of people making videos like this, um, people come and they ask for their money. When they ask for their money, unfortunately, most banks have lost a good amount of money in the bond market over the past couple of years because interest rates have risen. So they're not able to meet those. Therefore, they go under. And the FDIC comes in, takes over, right? So they had found Iowa Trust and Savings Bank as the acquiring. So good to see at least that other banks are willing to come in and take on these banks. We saw JP Morgan come in and take on First Republic Bank, Silicon Valley Bank. We saw First Citizens Bank and Trust come on and take that on. So there are solid banks out there. But with that being said, let's talk about what banks are at risk right now. So this here shows me the losses for a bank relative to their capital. So we can see here that First Republic is the number one bank in terms of losses relative to capital. They have 143%. Actually, they have a negative 143% loss to CET1 capital. It's basically just liquid assets. So that tells you that they have, more losses than they do assets. That means basically if every single depositor at that bank came and asked for their money, they wouldn't have it. And that's typical at most banks. But when you see a minus 430%, it won't take much to push that bank under. First, American Trust, number two worst bank, 125% loss to CTE, or excuse me, to CET1. Citizen State Bank, number three. Principal Bank, number four. Union County Bank, 5. And then Citizens Bank and Trust, 8. And so these are kind of smaller banks, yes. Horizon Bank I see at 24. Bank of Hawaii at 26. USAA, Federal Savings Bank. That kind of sucks. I know there's a lot of veterans in that. Minus 63%. Citizens Bank and Trust, First Bank, First Federal Bank, Charles Schwab is even on this list. American Heritage Bank, First Fidelity Bank. So I see Charles Schwab again on this list. So this is basically by branch. So Bank of America's on here. So yeah, I mean, this is definitely not insignificant banks here. Bank of Guam's on here. Farmers National Bank. So if you have money at any of these specific banks, you can see these branches are state by state. So if you're in this state with that bank, might make sense to transfer some money elsewhere, or at least make sure that you're under that 250,000 um, depository, requirement, or I shouldn't say requirement, really safety net from the FDIC. So if you're under 250,000 in any one of these banks, you're fine. The FDIC will come in and reimburse any losses. If you're over that amount, it may make sense to consider shifting some funds around. So crazy world that we're in right now. Obviously, I don't have any joy putting out a video like this. I know people are scared. I'm not trying to make them more scared, but I am going to at least acknowledge reality here. And another hard truth is the fact that unfortunately we're seeing another large signal of a widespread bank failure. And I just want to make one point before I move on. Actually, so the change in interest rates from Q1 to 2022 to Q2 of 2023 significantly increased the unbooked losses on the bank's balance sheets, as we have talked about. And unbooked losses rose 516 billion from Q1 of 2023 to 559 billion to Q2 of 2023. But this is still down from Q4 of 2022, which was at 610 billion. The point I'm getting at is that the last time these numbers were kind of updated in terms of losses, it was on June 30th of this year, when interest rates were at 3.82. Interest rates have hit a high on October 19th of 4.95, and they're significantly above 4% right now. So today's unbooked losses would be significantly greater than the end of June, where these numbers are coming from. Therefore, the unbooked losses are actually worse than I'm showing right now, and we'll get an updated number for this quarter in early November. So over the next couple weeks here, over the next couple of days, actually, we will get an updated number from the US FFIEC. They will release these numbers in their Q3 2023 call report. So that will come out in the next couple of days here, and that will update these losses numbers, which you can almost guarantee are going to get worse as interest rates have climbed since the last time these numbers have been updated. So just want to make that one point, that these numbers are actually probably understated for how bad they truly are, and we'll get an update within the next couple of days. But with that being said, I want to go over this last point here. So the Fed funds rate and the discount rate signal how confident banks are lending to each other. So the Fed funds rate, for those that don't know, is basically just the rate in which banks lend money to each other. And the discount rate is the rate in which the Federal Reserve lends to banks. The discount rate is always higher than the Fed funds rate. That's by designed to encourage banks to lend to each other more than the Fed lending out to banks. That just kind of makes banks more independent and less reliant on the Fed. So in conclusion, the discount rate is usually or pretty much always over the Fed funds rate to help and incentivize banks to lend amongst themselves rather than relying on the government. The issue is banks don't want to lend to each other right now. And we see that in the narrowing of the spread between the Fed funds rate and the discount rate. And I'll show you here. So right now, we can see that the spread has significantly tightened. So last month, the Fed funds rate was 5.3 and the discount rate was 5.5. Basically meaning that banks are not super willing to lend to each other. In fact, this spread is just a 3% spread. On average, since 2018, this spread has been 99%. So it's been nearly double. So it's almost been, 2 times cheaper to lend amongst banks than it has been to lend with the Fed. I know we're getting into the weeds, but just stick with me here. So this implies that banks are charging other banks higher rates to lend to each other, which signals that they don't want to lend to each other. Why don't they want to lend to each other? Well, because banks are smart and they see the assets that their lending partners have on their balance sheets, and they're pretty weak, and they're showing it with their dollars, right? They're showing it with their actions, right? You won't see a research report about this on Wall Street, but I'm covering it here today. And there's actually been brief times over the past couple years in which it's been cheaper to lend with the Fed than it has been to lend through the banks. So what I mean by that, it's been cheaper to use the discount rate, Fed lending to banks, than the Fed funds rate, which is the banks lending amongst themselves. So that's happened 6 times since 2018. And unfortunately, it's all happened roughly within the last 12 to 18 months. So this first happened in June of 2022. We saw the Fed funds rate be significantly above the discount rate, actually 17% above the discount rate. And then in September of 2022, we saw that just be roughly 2% above the discount rate. And then in November of 2022, we saw a 14% difference. In December, we saw a 2% difference. And think about it like this. What was the stock market doing during this time? Stock market was moving significantly lower. This is kind of a signal of what banks are thinking about the general economy, right? So I think this also kind of bodes poorly for the broader market, not just kind of banks likely to go under. And then what happens in January of this year? We saw that spread turn negative again, minus 2%. And then what happened in May of this year? We saw that spread be negative once again. Likely, SVB fear, all that was probably playing into it. And we've seen that spread remain pretty tight since the SVB failure. So we've seen that spread be consistently 3% since SVB went under. So that's still signaling that the banks don't want to lend to each other. They want money from the Fed. They prefer money from the Fed. Why? Because they don't trust each other. They don't trust each other for a very good reason. That's because they have a crazy amount of losses on their balance sheet, and they may not be able to meet their depository requirements if we do see a bank run. So, in conclusion, this spread between the Fed funds rate and the discount rate is signaling bank weakness, is signaling that banks don't want to lend to each other, and that's for a good reason. The average since 2018 has been 99%. We're at 3%. We're very tight right now. And I expect this could get even tighter, possibly turn negative for a month or two in reaction to this updated bank losses that we will get over the next couple days from the US FFIEC. There's a lot of risk out there right now. There's a ton of reasons to be concerned in the banking sector. Unfortunately, I think we probably see more bank failures before the year's over. If we do, that will obviously negatively affect the stock market. So this is kind of another reason to be cautious in the market. I've been cautious for the past couple months. Put a bunch of videos about my bearish thesis on the market. Had put my initial bearish video out in August. Put another one out about a month ago, so that's played out pretty well in terms of stock market performance. So if you're interested about, kind of keeping up with my thoughts on the market, please leave a like and subscribe. Would appreciate that a lot. Also, if you would like to get my day-to-day thoughts, I do have a Discord server below where I put out my day-to-day trades. If you're interested in that, You can sign up below. We have a free 7-day trial. Also, if you would like to learn more about the stock market, I have a course that basically just gives you the basics on the financial markets. I have a course below and I have a 50% discount for anyone on YouTube who's interested. Just use promo code YouTube. You can find that in the description below as well. So with that being said, I hope you enjoyed this video. I'll see you here next time.